Hello, class. This is Professor Reynolds, and what I thought I'd do is put together some videos to sort of help you go through the problem sets. Here is an example of what you'll be seeing. Uh, I will release these usually every Tuesday, but this will give you a guidance on basically how to do each problem. So if you follow these along, you should be able to do the problems fairly easily. You can see up here that there is resources, advanced accounting, enhance, or the text, chapter 1, page 17, the excess earnings approach to estimating goodwill. There's also a video in the resource section on this. So we're going to go through this and talk about the uh, different concepts and sort of explore how to do these. I have some notes here, and this is really on the excess earnings approach. But basically, the first chapters are going to be dealing with consolidations. Consolidations means that one company, a parent, buys another company and buys more than 50% of the stock. That way they have controlling interest. They have enough stock to outvote anybody else. So we'll have a parent, we'll have a subsidiary, and we have to figure out which is which. One of the concepts that we'll be talking about will be the concept of, how do you value the non-controlling interest? There are a couple of ways that we do this, and let's see, that way is either the parent concept or the economic entity concept. And there are some differences as far as how this is applied. The parent concept really just kind of looks at the consolidated income from the parents' shareholders. The consolidated financial statements reflect the shareholders or the stockholders' interest in the parent itself, plus the undivided interest in the net assets of the parent's subsidiaries. So the parent plus their percentage ownership of the subsidiaries. It represents a view that the primary purpose of the consolidated financial statements is to provide information relevant to the controlling stockholders. So we're really focusing on the controlling stockholders and worrying about theirs. There are going to be some differences, and we'll go through some of the exact exercises to show these differences. The non-controlling stockholders do not exercise control because they have less than 50%. And so their interest is presented as a liability, but technically it's really not a liability. So that's the parent concept. And we'll see again that the way that the whole entity is valued will be dependent upon whether you're using the parent concept or the economic entity concept. And we will be using the economic entity concept. The economic entity concept emphasizes control of the whole by a single management. So we're going to be combining the financial statements, and we're going to value the assets and the liabilities at their current fair market value. And the non-controlling interest is going to be a part of equity. It's kind of like having a second group of shareholders. And so the parent owns more than 50% of the subsidiary, but the non-controlling interest owns a part of that as well. So again, it's kind of like two classes of stock. Uh, the consolidated financial statements are intended to provide information about the group of legal entities. Uh, Both the controlling and non-controlling interest are part of the proprietary group of the consolidated entity. Uh, Meaningful evaluation by any interested party of the financial position and the results of operations is possible only if all of the assets are added to the consolidated financial statements. So you see that is important later on. So the first couple chapters, what we're going to be concerned about is how do you do the accounting? Um, FASB will say that the accounting needs to be done with the economic entity concept. So one of the components that we're going to be determining is goodwill. And goodwill is the difference between the market value of the assets and the price that you paid for them. Now, this is one of the few times in accounting where you can actually mark up your assets. And so, what's going to happen is that when you buy more than 50% of a company, that requires you to consolidate. And so, you're going to go and value their assets. And in some cases, let's say, for instance, that you have a building and it's in a growing city, you're going to put that building on your books at cost, and then you're going to depreciate it. Well, 5 years later, the building, because of the growth of this area, may be more valuable than your net book value or your book value, which of course is your cost less your accumulated depreciation. You're able to write these up. So the first thing you're going to do is you're going to get the market value of all the assets, all of the liabilities, and that is going to give you a net fair market value. And then you're going to determine the goodwill based on the difference between what you paid and what the fair market net value is. The difference is goodwill. Goodwill is not, okay, so this is a situation where it is a goodwill or an intangible asset without a definite life. So you don't amortize it. What you will do is that you will test it every year to make sure that the value is still there. Now, when you're buying a company, mainly what you're going to be looking at is cash flow. You're going to look to see how that company is going to integrate with yours, and you're going to be looking at that cash flow stream, and you're going to discount that cash flow at your required rate of return. And one of the ways of estimating goodwill and estimating the value of the company is the excess earning approach to estimating goodwill. Here it is the approach right here, and it's going to be part of the notes. But basically, what you do is that you determine what the rate of return for similar companies is, and then you discount that rate of return, and then you determine what your normal earnings would be. You will normalize these to take out any unusual events and put in any extra depreciation from marking up your assets. And then you'll compare those so that you get a goodwill figure. Now, so let's go ahead and go through one of the problems here. Now, as I said, you've got the excess of earnings approach. You can see the chapter 1 begins on page 17. So what do we need to know? Well, first we need to know what the fair market value of the assets and liabilities are. And in this case, it's 15 million fair market value of the assets and 8.8 million fair market value of the liabilities. Now, we also know that that increased asset means that the buildings have a 30% higher book value and land has a 75% higher book value. So we're going to mark those assets up, and we're going to disregard any accumulated depreciation on the company's books. We're only going to consider them as if we bought them, and that is our cost. However, if you buy assets and you mark up the value, then you are going to have to not only depreciate the way the company was doing before, you're going to have additional depreciation for the increased value. All right. So what we're going to do is look at the pre-tax earnings of Sheffield, which is the company that we're buying. Okay. And you can see that it was 1.2 million, 1.5 million, and $954,000. We want to normalize these earnings. Okay. You see that depreciation on equipment is 54,700. Depreciation on buildings is 961,000. We had an extraordinary loss in 2024. We had sales commissions each year, but we're not going to take that into consideration. So we've got the normal rate of return for the industry is 15%. So that's based on the net book value of the assets. And we can see here that we have fair market value of the assets is 15 million, the liabilities 8.8. That gives us a net of 6.2 million. We're going to multiply that by the normal rate of return. So that's going to be 6.2 million times 1.5. And so the normal yearly earnings that we should see would be 933,450. So now we're going to compare it to what we think the earnings of this company we're buying will be. In 2022, it's 1.2 million. We're going to subtract the additional depreciation for the markup at the building. All right. And you can see that is the normal depreciation on the buildings. And again, we've increased them 30%, so that's going to be an extra $288,000. You take that out, so 2022 earnings is 913, similar 2023. 2024, we had an extraordinary loss. We're going to add that back, subtract the depreciation, and so we'll get the earnings that we expect for the 3 years to be a total of almost $1 million. So that's average of 1,031,000 each year. We go back and figure the normal earnings is 933,450. So the excess earnings is going to be $98,000. So we believe that we're going to get 930 or $98,000 more than what the industry would expect. And we think we're going to get this forever. So we are going to discount this at just simple calculation of the excess earnings divided by our rate of return, which is 25%. And so our present value of the excess earnings is 393,280. So the implied value, of course, is going to be the net value of the assets plus the goodwill of 393,000. So we would offer 6.6 million. The next example will show you that, well, we think we're going to get a 15% return, but we think we're only going to get the earnings for 3 years, and then it won't matter. We take the same excess earnings target that we determined, 98,000, and we're going to look up a factor, and these are these tables. And so we're going to be looking up an ordinary annuity. We'll look under 15%, 3 years, and it will give us this factor of 2.28. We multiply that by the 98,000, and so that gives us a present value of 224,000. So again, the first example, we believe we were going to get these earnings in perpetuity. In this case, not only did we lower our return to 15%, but we also only think we're going to get them for 3 years. And so we're going to add that to the net book value, and that's how we get the $6.4 million. The other thing that we need to talk about would be this concept of the parent concept and the economic entity concept. In the first one, again, we're looking more at just the consolidating. And so we decide to buy 60% of a subsidiary company for $960,000. So that is our share of it. The non-controlling interest under the parent concept is simply their percentage of the net book value. So we have a net book value of $1 million of book value, same thing. And so we bought 60%, so they still own 40%. And so we believe that the total asset values that we would put on the books would be 1.36 million, which consists of our $960,000 and then their 40% of the existing assets for a total asset values of 1.36. Under the economic concept, though, what we're saying is that, well, if we buy something for 960,000 and we only buy 60% of it, that implies a value of $1.6 million. So if we have 960,000 of that, the remainder has to be the non-controlling interest. And so 40% of 1.6 million is 640,000. And so if we add 640,000 to this figure here, we're going to get the 1.6 million. And you can see under the parent concept, they're listed as a liability to non-controlling interest. But under the economic entity, since we valued it at 960, the whole company is worth 1.6 million. Now, in both situations, we have $960,000, okay? But under the economic unit concept, we're going to put this figure in equity. All right, so let's go on to the first example here. So here is what we're going, would be 1.5, all right? And so in this case, we're going to buy 80% of Cullimer Company for 1.5 million. Now their equity is a total of 1.536. You have common stock, other contributed capital, and retained earnings. So their total book value is 1.536. The controlling interest is going to be 20% or 307,000. Again, under the parent company concept, we're just going to multiply the non-controlling interest times the net book value of the assets. Under the economic unit concept, we're going to look at the implied value. So the implied value, again, is the common stock we issued divided by our ownership interest. So if we paid 1.5 million for 80% of the company, then the company should be worth 1.9 million. And so the non-controlling interest, they've gained as well. So their interest is $385,325. And the next problem is fairly similar. Okay. And then let's look at this problem where we're going to buy this company. We have all of their assets, and you can see that their net assets, really, you're going to be looking at this figure, which is $323,000. So we've agreed to buy them for 34,000 shares, $10 par value, but the stock is selling for $15 per share. So what are we all in for? Okay, 34,000 shares times 15 is 510. We're going to assume their debt, 59,500. So our total consideration given is 569,500. Now the fair value of the assets is going to be this 144,000, but their plant is worth about 10,000 more. All right, so the total value of the identifiable assets is going to be the 144,500 of the current and the marked up value, so 392,500. So we paid 569,500. So the total fair value of the assets is 392,500. So the goodwill is going to be 177,000. And so we're going to put that on our books. We're going to add that. We're going to debit current assets, 144,500. So we're going to add that to our current assets. We're going to put the plant and equipment at the 248. We're not bringing over any accumulated depreciation because this is what we paid. All right. And then we're going to add the goodwill of 177,000. All right. And then we have liabilities of 595,500 and common stock and other contributed capital. So The acquisitions expense, anything to do with the acquisitions, that's going to be an expense, and you just expense that, okay? You see, we paid cash, and so we're going to have a debit of the acquisition cost. And then other contributed capital, if you have stock issue cost, that is going to be a debit to the common stock account. So it really lowers basically what we would have gotten. And so that's pretty much the problems that you're going to be dealing with. Here, it's the next problem is a similar problem, except that you've got two entities. So you have to look at, well, what did we pay? Well, for Pronghorn, we paid 39,720 shares. So we paid that. We look at the assets. And so the applied goodwill is going to be here are the assets, here are the liabilities assumed, here's the fair value. And then we're looking at the difference between the total stock we paid and the fair market value of the assets. And then we just put them on our books. Okay, so assets less goodwill. So total assets are going to be 16161, and then liabilities, common stock, etc. So I hope this is helpful to you. I will try to do this for every week, but I can't guarantee because this is a fairly new course.